When learning options, how do I not get overwhelmed with the strategies that are always thrown around, such as butterflies, condors, collars, etc.? And what is a reasonable way to get started getting some first-time experience?
Okay. And some options traders are always giving out warnings about the amount of leverage used in options. Can you explain the leverage in options and the dangers of it? Sure. Okay, so the way the leverage, okay, so there are different, leverage is one of those loaded words, and it can mean a number of things. When I referred to leverage and when I use the word, what I think I really intend to say is that you're capable of getting returns that are greater than you would if you just bought the stock on extreme moves, right? Because if you think about it just logically, if you had to buy this stock at 100, there's a certain amount of margin you might have to put in your portfolio. There's a certain amount of money you have to have up to own this. But if you own options, and I don't know, it depends on your deal with your clearinghouse or with your broker or how it works. But when you own options, the most you can lose is the premium. So there is a fixed amount up front that you're going to be paying. But just think about the example of the 110 call that I gave 3 months out. If you're paying 50 cents, Johnny, you're in a situation where, let's say you bought 100 of them. Okay, that would be $50 in premium. Now, let's say you just decided to buy two, whatever the equivalent is, you decided to buy 2 shares at 100. Well, I guess that'd probably be, you decide to buy 10 shares at 100, let's say. Okay, so you decide to buy 10 shares at 100. So what happens in the case where we go to 150? Right? If you had just bought the 10 shares of the stock at 100, you would have made 50 times 10, you would have made 500. But if you had been able to spend just the $50 on that option premium, you're now going to own 50 futures of the stock from 110, and you're going to make 2,000 or 40 times 2,000, which is going to be obviously a multiple of just owning the outright shares. So again, it depends. If you go to 111, right? If you had just bought the 10 of the stock and you go to 100 and you go to 111, you make the $11. That's 110 owning the stock. If you own the calls, you might own 50, but you only made 50 cents or 50 cents on it because you spent 50 cents and you're buying them at 110. So you actually did better just owning the stock in that example. So the leverage, the concept of leverage, what I really mean to say is that there is an exponential return that you have on a big move owning those options. Because as you go higher and higher and higher, if it's an extreme move, as I said in this particular example where I thought of like 10 shares as an equivalent of owning, or instead of owning 50 options, once you go really far away, yeah, it's true, you missed the first $10, but you own 5 times as many of the options, and on a big move, you're going to have a outsized return. And as if you remember before, I was discussing on a $2 option that goes to 200, 44 to 1 on your investment. Again, we're talking about numbers that can get big on extreme moves, and that's where options, that's what I refer to when I'm talking about the leverage. On the short side, it's the same thing. You can never be short. If you ever are taking options from the short side, just understand that you can never be short more than you would be comfortable being long or short of the outright. In other words, I can sell 10 options perhaps, because as it goes through my strike, I might be comfortable being short 10 of the underlying if I'm short 10 calls, or I can sell the puts if I'm willing to get long 10 of the underlying 10 stock shares at a certain price. But from the long side, I can get long 500 futures if I buy the smallest thing on the board for a tick, and the market goes goes exponential. You're going to be participating in that and you're going to own 500 options. You can never be short 500 options though. It's why the game is different, and particularly I'm going to assume that even though I am a professional trader, generally I approach the market the same way I hope all of you are, which is capital preservation and money management being the first and most important goal of everything that you're doing. And in that light, you don't want to put yourself in situations where you can end up being long or short more of a particular underlying if the calls you sell or puts you sell go in the money. You do not want to think that you're collecting a certain amount of premium, and as long as nothing happens, you're fine. You have to make sure that you are comfortable getting called away on everything, because the options pricing, especially when things get a little wild, a lot of new players and sometimes experienced players will find that the options that they're short can go out and price far more quickly than they anticipated. And I just want to make sure that that is a cautionary note, that people understand. So as far as going in with first time experience and how to get started, I think if you're starting with options, the key is, I think you can make sure that you find somewhere where you can actively keep track of price, and where you have the ability to bring up a ladder and see what these options are priced at. When it comes to not getting overwhelmed, which is the other part of your question, Johnny, I would say make sure that you're not overwhelmed by these when you hear about structures like butterflies, collars, and different structures that you can create with options. These are really just ways to reflect certain risk points of view, or put on certain trades in a way that reflect a certain risk point of view that you might have within the market. So simply, a butterfly would be buying one option, selling two above or below it, and then buying another, usually equidistant. If you understand and learn the options theory behind what goes into those trades, what it allows you to do is find risk opportunities that have even more limited downside, but again, can allow you to structure a trade that makes sense with your perception of the market. You don't need to start out, however, understanding what a butterfly is if you are looking for long exposure to a exponential move, if you're a technical analyst or something like that. Learning these strategies and learning how options work over time will help you to better find ways to get better bang for your buck using options, if you're using them to play in a particular space. But understanding them, learning about options is critical, and you should always be learning about options. But I would not concern yourself, and that's what I'm saying. Don't get overwhelmed with trying to understand the complexity of a trade. Make sure you understand all of your best and worst case scenarios, and start with that. Start with very small money. Start with one lot, or just track price on options. See how they change over time. Watch what happens if you have an options pricing model. Watch what happens as you approach expiration, and the speed at which the change in value of options takes place as you approach expiration. If you have access to market pricing and can follow markets and just check in on where things are, I think just be a casual observer, and then you learn to ask questions and understand the market in the way that you do. I don't think there's a correct way to understand options. I know people who have made money trading options in completely different ways. So I don't want to emphasize that there's one way or a correct way. But to get started, don't take on short exposure you can't handle. Take a look at markets and track markets and options pricing before you get in. And when you get in very small, so that the lessons are meaningful, but not too financially painful to start, because the first few trades usually don't work out.